Put down your phone. Look at me. Right now, you are likely making 5 specific mistakes with your money that are quietly stealing your future. And if you don't fix them, not tomorrow, not next week, but right now, you are going to wake up in 10 years wondering why you're still running on the hamster wheel while everyone else is building real wealth. I'm Kevin O'Leary. You know me from Shark Tank. I've built multiple businesses, I've managed billions of dollars in assets, and I can tell you with absolute certainty that the difference between the people who die rich and the people who die broke isn't luck. It isn't their salary, it's their behavior. Specifically, it's the 5 mistakes I see retail investors make over and over again. Mistakes that leave them bleeding money to fees, chasing losses, and buying assets that are guaranteed to depreciate. Before I expose these 5 mistakes and more importantly show you exactly how to fix them, I need you to do something. Hit that subscribe button, smash it. Join the hundreds of thousands of people who are tired of getting soft, polite, politically correct financial advice. Here we tell you the truth because the truth is the only thing that's going to make you money. Now let's get into it. I'm going to name the first mistake right now, and I guarantee you're making it. Let me ask you a question, and I want you to be brutally honest with yourself. When you look at your investment portfolio, your 401k, your IRA, that Robinhood account you check 17 times a day, do you actually have a plan, or are you just hoping? Here's the brutal truth that nobody on Wall Street wants to tell you. Hoping is not a strategy. Hoping is what poor people do with their money. Wealthy people don't hope. They execute. They have systems. They have rules. And right now, you're operating on guesswork while the financial industry is laughing all the way to the bank. Let me give you a specific number. The average retail investor, that's you, if you're managing your own money without a system, underperforms the S&P 500 by nearly 4% annually. 4%. Over 30 years on a $100,000 portfolio, that's not a small mistake. That's $324,000 left on the table. $324,000 that you worked for, that you earned, that you saved, gone because of mistakes you don't even know you're making. And the worst part? You think you're being smart. You think you're doing the right thing. You read an article about a hot stock, so you buy it. You hear your cousin made money on crypto, so you throw a few thousand in. You see the market drop, so you panic and sell. This is what Kevin O'Leary calls the retail investor death spiral. And it's a cycle that keeps you broke while the institutions, the people who actually understand how money works, buy your assets for pennies on the dollar. Let me paint you a picture. Imagine you're trying to fill a bathtub with water. You turn the faucet on full blast. That's your income, your hard work. But you've got the drain wide open. The drain is fees. The drain is bad advice. The drain is buying high and selling low. The drain is holding cash that's being eaten alive by inflation. You can work 80 hours a week. You can get promotions. You can save every penny. But if the drain is open, you will never fill the tub. That's where you are right now. And it's not your fault. The system is designed to keep you confused. Financial advisors? Most of them are just salespeople in suits who get paid to put you in high-fee mutual funds that line their pockets. Banks? They pay you 0.01% interest on your savings while charging you 18% on your credit card. They are not your partner. They are your counterparty. Every dollar they make is a dollar you don't have. Here's the reality that keeps me up at night when I think about regular people trying to build wealth. Inflation is running at 3 to 4%, sometimes higher. Cash is guaranteed to lose value. The dollar in your pocket today will buy less tomorrow. That's not speculation, that's math. If you're sitting on cash waiting for the right time to invest, you're not being cautious. You're being destroyed, slowly, quietly, and absolutely certainly. Now, I can see some of you nodding your heads. You feel this. You know something's wrong, but you don't know how to fix it. You're frustrated. You're tired of feeling like you're behind. And let me tell you something. That frustration is the most valuable asset you have right now, because it means you're ready to listen. It means you're ready to stop making the same mistakes and start doing what actually works. So what are these 5 mistakes? What's the system that's going to close that drain and finally start filling your tub? That's exactly what I'm about to give you. So what's the solution? I'm going to give you a framework, a system, 5 specific mistakes that you're probably making right now, and, more importantly, exactly how to reverse each one. Kevin O'Leary has a saying, money is like soap. The more you handle it, the less you have. And that's the problem with most investors. They're handling their money too much. They're touching it, moving it, worrying about it, checking it every single day. And every time they touch it, they make it smaller. The framework I'm about to give you is designed to do one thing, get you out of your own way so your money can actually grow. Here's what we're going to cover. First, we're going to talk about the mistake of treating investing like gambling, chasing hot tips, timing the market, and confusing activity with productivity. I'm going to show you why the wealthiest people I know, the billionaires, the institutional investors, do almost nothing compared to the average person, and yet they make exponentially more. Second, we're going to expose the silent killer in your portfolio, the thing that's taking a guaranteed slice of your returns whether your investments go up or down. Most people don't even know how much they're paying. I'm going to show you exactly where to look and how to cut this cost by 90%. Third, we're going to look at what you actually own. I'm going to ask you a question that most investors can't answer. And if you can't answer it, you're holding a time bomb. We're going to fix that with a simple rule that takes 5 minutes to implement and will protect you from catastrophic losses. Fourth, we're going to address the emotional disaster that is watching your portfolio. I'm going to tell you why checking your investments daily is one of the most destructive habits you can have, and I'm going to give you a specific schedule down to the number of times per year that will actually make you richer. And finally, we're going to talk about cash. I'm going to tell you why the safe money in your bank account is actually the most dangerous asset you own and what to do about it. Now, before I dive into these 5 mistakes, I want you to do something for me. Hit the like button on this video, not because it helps the algorithm, though it does, but because I want you to make a commitment right now. Clicking that button is you saying, I'm done making these mistakes. I'm ready to take control. Do it. Right now. And if you want to go even deeper, if you want the actual portfolio allocations, the specific ticker symbols, the exact way Kevin O'Leary structures his own money, comment the word system below. I'm going to be looking at those comments, and I might just drop some additional resources for the people who are serious enough to ask. Now let's stop talking about what you're doing wrong and start fixing it. Let's get into mistake number 1. 1. The first mistake, and this is the one that kills more portfolios than anything else, is treating the stock market like a casino. You know exactly what I'm talking about. You see a stock popping off on Reddit. You hear some guy on TikTok telling you about a guaranteed 10-bagger. Your buddy from college made 30 grand on some cryptocurrency you've never heard of. And what do? You chase it. You throw money in hoping to catch the wave. And then, surprise, surprise, you buy at the top, watch it crater, panic, sell at the bottom, and swear you'll never do it again. Until next week, when the next shiny object appears. Let me be crystal clear about something. Kevin O'Leary doesn't invest in stories, he invests in businesses. There's a massive difference. When you buy a stock based on a tip, a trend, or a feeling, you're not investing. You're speculating, and speculation is just a fancy word for gambling. The house, the institutions, the market makers, the people with algorithms and information you don't have, always wins. Here's what that actually looks like in dollars. Let's say you have $10,000, you hear about a hot stock, buy in at $50 per share, it jumps to $60, you're feeling like a genius, so you buy more. Then it drops to $40, you panic, sell everything, and lock in a $2,000 loss. Meanwhile, the institutional investors who bought at $30 when nobody was paying attention are selling to you at $50, then buying back from you at $40. They profit on the way up and on the way down. You get crushed. Now here's where people usually ask me, Kevin, how do I know the difference between investing and gambling? The answer is simple. Investing is when you buy an asset that produces cash flow, a business that makes money, a rental property that pays rent, a dividend stock that sends you a check every quarter regardless of what the market does. Gambling is when you buy something and your only hope of making money is selling it to someone else for a higher price. If you can't explain in one sentence how the thing you're buying makes money, you're gambling. Period. Write that down. Put it on your desk. If you can't explain the business model in one sentence, you don't own an investment. You own a lottery ticket. So what do you do about it? Here's your action plan. The next time you want to buy any stock, any crypto, any asset at all, stop. Ask yourself one question. Does this produce cash, or am I hoping someone will pay more for it later? If the answer is the second one, walk away. I don't care how hot the tip is. I don't care how many people are getting rich. You are not them. And 9 times out of 10, they're not even getting rich. They're just the ones who got in early and are now looking for a sucker to buy their bags. Don't let that sucker be you. This leads directly into the second mistake, which is even more dangerous because you don't even know you're making it, and it's costing you a fortune every single year. 2. The second mistake is ignoring fees. And let me tell you, this one makes me angrier than almost anything else in the financial world. You're out there grinding. You're working overtime. You're skipping the fancy coffee, packing your lunch, doing everything right to save money, and then you turn around and hand a massive chunk of your investment returns to people who did absolutely nothing to earn it. People you've never met, people who don't know your name, don't know your goals, don't care if you succeed or fail, and you're paying them thousands of dollars a year for the privilege. Here's the brutal math. Let's say you have $100,000 invested. You're in a typical mutual fund with a modest expense ratio of 1%. That's $1,000 a year. Doesn't sound like much, right? But here's the part the industry doesn't want you to think about. That 1% isn't just 1% of your principal. It's 1% of your returns, year after year, compounding against you. Over 30 years, assuming a 7% annual return, that 1% fee doesn't cost you $30,000. It costs you over $100,000. $100,000. That's a down payment on a house. That's a kid's college education. That's 5 years of retirement, gone, for nothing, and I'm being generous. I'm not even talking about the advisors who put you in funds with 2% fees. I'm not talking about the front-end loads. That's where they take 5% of your money the second you invest it. I'm not talking about the back-end loads, the 12b1 fees, the account maintenance fees, the trading commissions. Layer all that on top and you're looking at a portfolio that has to return 8 or 9% just for you to break even on the fees. Kevin O'Leary has a rule. It's very simple. Never pay more than 0.2% in fees on any investment. That's 20 basis points. Nothing more, ever. Now I can hear the objections already. But Kevin, active managers earn their fees. They beat the market. Let me stop you right there. That's a lie. It's been proven over and over again. Over a 15-year period, more than 90% of active fund managers fail to beat their benchmark. 90%. You are not picking the 10%. Nobody picks the 10% consistently. It's statistically impossible. So what do? You fire your expensive advisor. You move your money into low-cost index funds. You pay 0.03% instead of 1.5%. And you keep that $100,000 in your pocket instead of handing it to some salesman in a nice suit who calls himself a wealth manager. Here's your action step. Right now, and I mean right now after this video, go look at your 401k. Go look at your IRA. Look for the line that says expense ratio or management fee. If it's above 0.20%, you're getting ripped off. Move that money. It takes 15 minutes to open an account at Vanguard, Fidelity, or Schwab. 15 minutes to stop the bleeding. There's no excuse. Now, the third mistake is related to this one, but it's actually more dangerous because fees just cost you money. The third mistake can cost you everything. 3, the third mistake is something I call owning the ghost portfolio. Here's what I mean by that. I ask people all the time on Shark Tank and meetings at conferences, what do you own? And they'll say something like, I own stocks, or I'm in the market, or I have a diversified portfolio. That's not an answer, that's a dodge. And if that's the best you can do, you don't actually know what you own. You're just hoping that someone else figured it out for you. And let me tell you something. Nobody cares about your money as much as you do. Not your advisor, not your broker, not the guy on YouTube telling you about the next big thing. Only you. Kevin O'Leary has a very specific rule about portfolio construction. He calls it the Lucky 13. He owns exactly 13 stocks, not 50, not 100, not a mutual fund with 300 holdings that he can't name, 13. And he knows every single one of them. He knows what they do. He knows their profit margins. He knows their debt levels. He knows their management teams. He can explain in one sentence why each one makes money. Can you do that? For most of you watching, the answer is no. You own a collection of ticker symbols that someone recommended. You have no idea how much of your portfolio is in tech, how much is in energy, how much is in international markets. You're flying blind. And in a market downturn, and there will be a market downturn, there always is, you're going to panic because you don't actually know what you're holding. Let me give you a specific example. During the 2008 financial crisis, people who owned diversified portfolios of high-quality businesses lost money on paper, but they held on. They knew what they owned. They knew the businesses were still profitable, and within 5 years, they were back to even, and then some. But the people who owned the market, who didn't know what they had, they sold at the bottom. They locked in their losses, and many of them never came back. Here's your action step. Block out 2 hours this weekend. 2 hours. Open every single account you have. Write down every single holding, and I mean every holding. Then next to each one, write down 3 things. What the company does, its profit margin, and its debt-to-equity ratio. If you can't find that information in 10 minutes, you don't own that stock. Sell it immediately. I'm not saying you need to own 13 stocks like I do. That's my system. But you need to own something you understand. Warren Buffett has a saying, never invest in a business you cannot understand. That's not a suggestion, that's a survival rule. Now, once you know what you own, you run into the fourth mistake, and this one is purely psychological. It's the thing that separates the wealthy from the people who stay stuck forever. 4. The fourth mistake is checking your portfolio too often, and I know this one is going to hit some of you right in the gut. You know who you are. You're the ones who open your brokerage app the second the market opens. You check it during lunch. You check it when you get home. You check it before bed. You're watching every tick, every fluctuation, every meaningless little wiggle. And every time you look, you're doing damage, not just to your portfolio, but to your brain. Here's what's happening. The market goes up and down every single day. That's what it does. It's noise. But when you're looking at your account every day, you feel every one of those movements like it's real money. Your portfolio drops 1% on a random Tuesday, and suddenly you're anxious. You're thinking about selling. You're questioning your strategy. You're making emotional decisions based on information that has absolutely no bearing on your long-term returns. Kevin O'Leary checks his portfolio 4 times a year. That's it, 4 times, once per quarter. And you know what? He's one of the wealthiest people in the world. The correlation between checking frequency and returns is inverse. The more you check, the worse you do. Why? Because checking creates emotion. Emotion creates mistakes. Mistakes cost money. Let me give you the data. A study from Fidelity looked at their best performing accounts. You know what they found? The best accounts belong to two groups, people who had died and people who had forgotten they had an account. That's not a joke. The people who did nothing, who didn't touch their money, didn't check it, didn't try to time the market, outperformed everyone else. Now, I'm not telling you to forget you have money. I'm telling you to stop touching it. Stop looking at it. You are not a trader. You are an investor. Traders look at screens all day and pretend they can predict the future. They can't. Investors buy quality assets, hold them, and let compound interest do the work. It's boring. It's simple. And it's the only thing that actually works. Here's your action step. Delete the app. I'm serious. Delete your brokerage app from your phone. If you want to check your portfolio, you have to log in on a computer. And you're only allowed to do that 4 times a year. Mark it on your calendar. January 1st, April 1st, July 1st, October 1st, those are your days. The rest of the time, you're focused on your income, your business, your career, the things that actually generate the money you invest. And here's the thing, when you stop looking at your portfolio, something magical happens. You stop worrying, you stop panicking, you stop making dumb decisions, and your money starts growing quietly, consistently, without you sabotaging it. But there's one more mistake, and this one might be the most dangerous of all, because it feels like safety, it feels like responsibility, but it's actually a trap. 5. The fifth mistake, and I've saved the most dangerous one for last, is holding too much cash. Now, I know what some of you are thinking. Kevin, cash is safe, cash is secure, cash means I can sleep at night. Let me tell you something, and I want you to hear me clearly. Cash is not safe. Cash is the most dangerous asset you own, because cash is the only asset that is guaranteed to lose value every single day, without exception. You think you're being conservative. You think you're being responsible. You've got $50,000 sitting in a savings account earning 0.5% interest. Maybe you're proud of yourself. Look at me, you say. I've got a safety net. And you do. That's fine. But if you've got more than 6 months of expenses in cash, you're not being safe. You're being destroyed. Let me do the math for you. Inflation is running somewhere between 3 and 4%, sometimes higher. Cash pays you less than 1%. That means every year, every single year, you lose 3% of your purchasing power. On $50,000, that's $1,500 gone. Not on paper, not in the market. Gone. You can't get it back. It's been stolen by inflation while you were congratulating yourself for being safe. Now let's stretch that out over 10 years. That $50,000 in cash is now worth about $37,000 in purchasing power. You've lost $13,000. You worked for that money, you saved it, you sacrificed for it, and you gave it away to inflation because you were too afraid to put it to work. Kevin O'Leary holds cash. I'm not saying cash is bad. I'm saying too much cash is a disaster. How much is too much? Here's the rule. 6 months of living expenses. That's it. That's your emergency fund. That's the money that lets you sleep at night. Everything above that needs to be working. It needs to be in assets that produce cash flow, stocks that pay dividends, real estate that generates rent, businesses that make profit, things that go up when inflation goes up, things that protect you instead of leaving you exposed. I hear the excuses. But Kevin, the market is too high right now. Kevin, I'm waiting for a pullback. Kevin, I don't want to buy at the top. Let me ask you something. Do you know when the market is going to pull back? Do you know when the top is? Of course you don't. Nobody does. And while you're sitting on the sidelines waiting for the perfect moment, you're missing out on dividends, you're missing out on compound growth, and you're guaranteeing yourself a 3 to 4% annual loss from inflation. The perfect moment doesn't exist. The only moment that exists is now. Here's your action step. Look at your cash reserves. If you have more than 6 months of expenses sitting in a bank account, you are going to move that money by the end of this week. I'm not telling you to gamble it. I'm telling you to put it into a low-cost, diversified portfolio of assets that produce cash flow. If you don't know where to start, you start with an S&P 500 index fund. It's simple, it's boring, and over time, it will make you wealthy while your friends who are waiting for the right time are still sitting on cash that's losing value every single day. Those are the 5 mistakes. Gambling instead of investing, paying fees you don't understand, owning things you can't explain, checking your portfolio constantly, and holding too much cash. Now let me show you how to put all of this together. Now let's put this all together, because I don't want you to just nod along with these 5 mistakes and then close this video and do nothing. That's what most people do, and that's why most people stay stuck. I'm going to give you a concrete action plan, a real-world example of how to take these principles and actually implement them. And I'm going to use specific numbers so there's no confusion. Let's say you have $50,000 in total savings and investments. Here's exactly how you should deploy it, based on everything I've just told you. Step 1, your emergency fund. You need 6 months of expenses in cash. Let's say your monthly expenses are $4,000. That means you need $24,000 in a high-yield savings account, not in your checking account earning nothing, not in a CD where you can't access it, a liquid high-yield savings account where you can get to it tomorrow if you need it. That's your safety, that's your sleep at night money, that's non-negotiable. Step 2, everything above that works. You've got $26,000 remaining. That money does not sit in cash. That money goes to work. And it goes to work in investments you understand, with fees you can see, in a structure that prevents you from touching it too often. Step 3, the investment vehicle. You open an account at Vanguard, Fidelity, or Schwab, not Robinhood, not some app with confetti that makes you feel like you're winning when you're actually gambling. A real brokerage. And you put that $26,000 into a low-cost S&P 500 index fund. The ticker is VOO or SPY or FXAX. The expense ratio is 0.03%, not 1%, not 2%, 3 basis points. That's it. Step 4. The automation. You set up automatic contributions. Every month on the day you get paid, $1,000 moves from your checking account into that index fund automatically. You don't think about it, you don't touch it, you don't check it, it just happens. Over time, that $26,000 becomes $50,000, becomes $100,000, becomes $500,000, and you didn't have to be a genius. You didn't have to time the market, you just followed the system. Step 5, the discipline. You check this account 4 times a year, January 1st, April 1st, July 1st, October 1st. On those days, you look at the balance, you update your spreadsheet, and you close it. You do not sell based on what you see. You do not panic. You understand that the market will go up and the market will go down, and over time, over decades, it will go up more than it goes down. This is not theoretical. This is exactly how Kevin O'Leary deploys capital. This is how the wealthy people I've spent 40 years studying build their wealth. It's not complicated. It's not exciting. It's systematic. And it works. Now, I know some of you are going to watch this and think, that's too simple. There must be something I'm missing. You're not missing anything. The reason most people don't get wealthy isn't because the information is hidden. It's because the information is boring. And boring doesn't sell. Boring doesn't get clicks. But boring makes you money while everyone else chases the next hot thing and gets crushed. So here's your choice. You can keep doing what you're doing. You can keep chasing tips, paying high fees, checking your phone 17 times a day, holding cash that's losing value and wondering why you're not getting ahead. Or you can follow this system. It's your money. It's your future. And the clock is ticking. Too many people watch videos like this, nod their heads, say that makes sense, and then close the browser and do absolutely nothing. They go back to the same habits. They go back to checking their portfolio every day. They go back to holding cash that's bleeding value. They go back to paying fees they don't understand. And then 5 years pass, 10 years pass, and they're standing in the exact same place wondering why nothing changed, wondering why they're still stressed about money, wondering why retirement feels further away than it did a decade ago. Don't be that person. I'm telling you right now, every single day you wait is another day your money is being destroyed by inflation, by fees, by your own emotional mistakes. The cost of inaction is not zero, it's not small. It's the difference between retiring with dignity and working until you drop. Let me give you one more number. A 25-year-old who invests $500 a month in a low-cost S&P 500 index fund with an average annual return of 7% will have over $1.2 million by age 65. That's not speculation. That's math. That's compound interest. That's the 8th wonder of the world, as Albert Einstein called it. But that same person, if they wait just 5 years to start, if they spend those 5 years holding cash, chasing tips, making the mistakes I've outlined today, that $1.2 million becomes $800,000, a $400,000 penalty, $400,000 for the crime of waiting, for the crime of inaction. Now, some of you are going to say, Kevin, the market is too high right now. I'll wait for a pullback. And that's exactly what people said in 2015 and in 2017 and in 2019 and in 2021. And if they had waited, they would have missed the greatest bull market in history. You cannot time the market. Nobody can. The only thing you can control is when you start. So here's my challenge to you. Before you close this video, you're going to take one action, just one. Maybe it's logging into your 401k and checking your fees. Maybe it's deleting the trading app from your phone. Maybe it's moving 6 months of cash into a high-yield savings account. Maybe it's setting up that automatic contribution. One action. Today, right now. The people who will be wealthy 20 years from now are not the people who watched this video and nodded along. They're the people who took action. Today, while everyone else was waiting, while everyone else was making excuses, while everyone else was letting fear make their decisions. Be one of those people. Now, before I let you go and take that action, I need you to do 3 things for me. And I'm not asking, I'm telling you, because this is how we build a community of people who actually do what it takes to build wealth instead of just dreaming about it. First, hit that like button. Smash it. I want you to do it right now while I'm talking. Here's why. When you like this video, you're telling the algorithm that this kind of content matters, that the truth matters, that hard financial education matters more than hype and gambling and get-rich-quick nonsense. And more than that, you're making a commitment to yourself. You're saying, I watched this, I heard it, and I'm taking it seriously. So do it right now. Second, if you haven't already subscribed, subscribe to this channel. Hit that subscribe button and become part of this community. There are already hundreds of thousands of people here who are done with the lies, done with the soft, polite advice that keeps people poor, done with making the same mistakes over and over again. Join us, because every week I'm dropping content just like this. No fluff, no filler, just the truth about how money actually works. Third, leave me a comment, and I want you to be specific. I want you to comment the one action you're going to take today, not tomorrow. Today. Maybe it's I'm checking my fees. Maybe it's I'm deleting the app. Maybe it's I'm moving my cash. Write it down. Put it in writing. Because when you commit publicly, you're far more likely to actually do it. And I read these comments, I see them. I want to know that this video made a difference for you. And if you want to go even deeper, if you want the actual portfolio allocations, the specific numbers Kevin O'Leary uses in his own portfolio, the exact breakdown of how to structure your investments across different accounts, hit that notification bell, turn on all notifications, because I've got a follow-up video coming that breaks down the actual portfolio of a billionaire, and I'm only sending it to the people who are serious enough to turn on those alerts. Now let me leave you with this. I believe in you. I genuinely believe that you can do this. I've spent 40 years in business, 40 years watching people build wealth and watching people destroy it. And the difference was never intelligence. It was never luck. It was never how much money they started with. It was discipline. It was following a system. It was refusing to make the mistakes that keep most people stuck. You have everything you need right now to start building real wealth. You don't need more money. You don't need a better job. You don't need a hot tip. You need a system. And I just gave it to you. So stop making excuses. Stop waiting for the perfect time. Stop letting fear run your financial life. Take that one action today and then come back tomorrow and take another one and another one and another one. And one day you're going to look up and realize you're not worried about money anymore. You're not stressed. You're not behind. You're building wealth the right way. Join the hundreds of thousands of other people in this community who are doing exactly that. I'll see you in the next video. Now go take action.